bridge loans. Most people, once again, think that bridge loans are tied to interest rates. They're tied to the direction of interest rates. Today, bridge loans are there. Anyone can get a bridge loan, but the math doesn't make sense. We're all math driven. We look at underwriting, we look at bridge loans, and we go, nah, this doesn't make sense.
Welcome back to Keeping It Real Estate. Today we have an extremely special guest on our show, Neal Bawa. Neal has over 4,800 units under management, equating to $1 billion in value. Neal speaks at dozens of real estate conferences across the country. Over 5,000 investors attend his multifamily webinar series each year, and hundreds have attended his Magic of Multifamily boot camps. Neal, welcome to the show. It's a pleasure to have you with us today.
Great to be on the show, Dan. I'm excited for the topic that we've talked about discussing today.
Beautiful. So maybe you could start with a little background on yourself, just so if any listeners don't know who you are.
I'm a technologist. I'm a nerd, a geek, whatever you want to call it. I'm steeped in Silicon Valley lore, and my goal as a data scientist is to apply large amounts of data. We call it big data, to real estate in a way that's very unique, and I've not seen anyone else apply that in that fashion. There are lots of data-driven people in real estate. In fact, I think most people in real estate are data-driven, but big data is not the same as being data-driven in your decision-making, and that's my goal. And it's worked really well for me. I've been applying data to real estate since 2009. Firstly, for myself, I did real estate for about 11 years before I ever took an investor's money, and then I've been doing it for 9 years with investors' money. And nerdy, geeky investors. A lot of them are Silicon Valley technologists. A lot of doctors, 300 plus doctors. So about 1,000 investors, and I've taken about $290 million of their money to build a $1 billion portfolio. And they have now given me $120 million on what I call my mission, my jihad, my life mission, which is called Mission 10K, a mission to build 10,000 townhomes in the United States.
Wow, that's awesome. Well, I appreciate that. So real quickly, before you just breeze away from that, your mission is to build 10,000 townhomes of real estate across the U.S.
That's right. So we're building 100 communities. Each community is an average of 100 units. So some are 80 units, some are 120 units. And these communities are in very specific markets. I can only today, with the construction costs and interest costs being so high, property taxes being so high, I can only build Mission 10K properties in 4% of the United States. So that's 4% of the US population. Out of 330 million, I can build it in areas that have 13 million people living. And that 4% is based on a humongous, ridiculously large amount of data science that we put in. Just massive millions and millions of parameters were used to find that 4% of the United States.
Wow. Okay, great. Well, that's awesome. What a great endeavor, goal to have there. Why did you choose commercial real estate as an asset class when you kind of got going? 11 years ago, 10 years ago, because you did 11 years on your own and then 9 years now with
yes.
Capital, right?
So bottom line is I didn't choose commercial real estate. Commercial real estate chose me. So in 2003, I walk into my boss's office. He was a senior partner in the firm. I was the junior partner. They're just two partners in the firm. And he says, I'm really, really fed up being a tenant. Landlords hate us. We're just going to build our own campus. And this is our technology company, nothing to do with real estate. And I'm like, you go, Paul. And he says, yes. And we're going to build it in the next year. And I'm like, you go, Paul. And he's like, yes. And you're going to build it. And I just peed in my pants right away. I'm like, I have a shed that I ordered from Costco that's been sitting in my side yard for a year because I'm terrified of making an 8x8 shed. You want me to build a $10 million campus? Yes. So my boss had insane amounts of confidence in me, or overconfidence in me. Luckily, I was able to find a retired general contractor to guide us through the process. And even then we screwed it up then 50 different ways. No investors, cash money. The company wasn't taking loans or anything like that. And we built this first beautiful campus, 27,000 square feet in Fremont, California. Got a freeway sign out of it, which was really nice. And the campus really changed our business because it made us a much more nimble organization because we had custom built it to our use, elevated our business to the next level. And both Paul and me ended up having incredible tax benefits And once I realized, oh my God, this real estate thing, the tax benefits are completely insane, I never let go. I built 6 more campuses. And by 2009, when the crash happened, I was ready. I had money in the bank, and then I just went a little insane with real estate.
Wow. Okay, so let's talk about where we are today.
Mhm.
The market, it's on everyone's mind right now. Why don't you share maybe where the commercial real estate market was over the last 2 years, where it's now, and then where you think the market's going based on the data you're finding and seeing?
Absolutely. Well, first thing I want to do is this word commercial real estate can mean different things to different people. So let's define that, right? Let's define what does commercial real estate mean? Well, the biggest definition is, well, it means all kinds of assets, including multifamily over 4 units. So when you take, multifamily below 4 units is considered single family, or 4 units and below, 5 and above are part of commercial real estate. But most people, when they use the word, they often don't mean multifamily, or they say things like multifamily and commercial real estate. So in practical use, commercial real estate often stands for things like hotels, malls, offices, other weird forms of housing like senior housing, self-storage, properties, mobile home parks. That's really commercial real estate, right? So it's basically all forms of real estate that is usually held by large companies. So it's not, individual investors that are holding these. And then you can say one part of that is multifamily. And today we are at a very interesting crossroads where this exorbitant, ridiculous increase in interest rate, especially what happened in the last 30 or 40 days. The single family rates went from low sevens now to eights, right? So a single family right now is in the 8% range. You can imagine multifamily not quite there. So right now you can get a Fannie Mae Freddie Mac loan, but it's 6.5, 6.6, 6.7%, where that loan was 5.1 just 4 months ago. The market's finally realizing is, hey, it's the Fed's going to keep rates lower for longer, so we need to basically have our interest rate match the Treasury rate, which has gone from 3.5% to 5% in the last 4 months. So now, as a result, interest rates are also going up as 10-year Treasuries are going up. So this is likely to cause, and I'm going to use this word here, so that we're in October, late October, early November of 2023. I'm going to use this word. There will be distress in every single form of commercial real estate in the next 18 months, and I am rubbing my hands with glee.
I'll let that sink in a little bit. So, and I just want to make sure I heard you correctly. I think you said that when we were just chatting right there, you said rates were going to stay lower for longer. Did you mean higher for longer?
Sorry, higher for longer.
Okay, got you. So basically, with the rates running up like they are, the 10-year, the 7-year, the 5-year just dramatically increasing like they have over the last 4 months, you've got a lot of folks that, as much as they would like to get out of these deals, they're not going to be getting out of these deals for even close to what they have in them. And due to where they are, there will be major price reductions, which will allow for folks to be buying deals at a great discounted price. Is that pretty much what you were saying, Neal?
Absolutely. And that discount varies. So for multifamily, the discount will be 25 to 30% on the same profits. The key thing is this, right? The price really doesn't matter. What is a discount, right? Well, a discount is off of a certain peak, right? So you say from a peak, how much did I get less? As long as my net operating income didn't change, because if my net operating income went down, that's not a real discount, right?
Mm-hmm.
So for dollar, if you have $1 of NOI, if you're buying a property for 25% less, well, that's a 25% discount. But if your NOI went down 10% and you're getting a 25% discount, that's more like a 15% discount. So it's not real, right? So we're talking about net operating income remaining the same and still you're paying 25% less. We think today, right now, November 2023, today you're getting 25% discounts on multifamily. Where was the peak? It was March 2022. March 2022 was the peak for multifamily. Every other asset class in commercial real estate has a different peak date. Office peaked at 2019 before COVID, right? So that was the peak that we look at for office. And for office, and I'm going to be very specific. So I want to be very, very specific. Not all office, right? That word means a lot of different things. But for older office buildings that are B and C class, when I look at what that peak was in 2019 and what the prices are going to be in 2024 and 2025, office distress lasts longer. Office will be discounted by 70 to 80% for those types of assets. 70 to 80%. In 2024 and 2025, multifamily 25 to 30%. And then everything else is somewhere in between those two numbers. So I expect retail assets of certain kinds, not every kind of retail asset, to be discounted, in the 30s or in the 40s percentile. I expect some kinds of hotels to be in the 30 percentile range. Hotels have actually been doing pretty well. And then I expect self-storage to be discounted right around that multifamily range in the 25% range, and industrial also in the 25% range. So distress starting at 25, going up to 80, depending upon asset class and where it is.
That's exciting news, and it's exactly what we're seeing and exactly where we're at as far as, hey, we finally see these major pullbacks, and a lot of these deals, the NOI has actually been increasing.
They have been increasing, right? So, I mean, if you think about it, in the last year, multifamily rents have been flat. What does flat mean? Flat means half of the United States saw increases and the other half saw declines because you average it out, right? So the last 12 months, rent growth in the US has been flat, which means 50% of the properties had positive rent growth. What that means is 50% of the property, the net operating income actually increased, but you're still paying 25, maybe 27% less than you would have paid in March 2022. That's what's exciting to me. We've had our bad year of rent growth. So first we had an insane year of rent growth, right? So if you go back the last 12 months, we've had no rent growth in the US, right, on average. And then 12 months before that, we had absolutely batshit crazy 16% rent growth. And the year before that, it was 8. So if you take 8 plus 16, that's 24 plus 0, right? That's still 24. 24% rent growth in 3 years is 8%. The 50-year average is 2.5%. So your 50-year average was 2.5%. In the last 3 years, you've had basically at 8, which is more than 3 times the 50-year average. So it's not like rent growth is doing poorly in the United States, and it's not like occupancy for multifamily is doing poorly. We're at 94.5%. The 50-year average is around 93, so we're above the 50-year average. Occupancy is fine. Rent growth, we've had our super good year and our super bad year. Well, not super bad, just no rent growth. And now we're ready. We've reset because we had a year to catch up on that 16% of rent growth. Now we're ready to start having reasonable rent growth going forward. So I'm projecting between 1 and 2% rent growth for the next 12 months, which includes a 6-month recession. And then after that, I'm projecting 3.5-4% rent growth. Why? Because we've stopped doing new construction for multifamily. 71% of multifamily projects that were supposed to start new construction in the last 6 months didn't, which means that in 2026, we're going to have very low deliveries. Not in 2025, because a lot of that 2025 stock, it's already started, right? So once it starts, it's going to finish. So 2026 is that year where we are going to create a big supply hole because we didn't start new buildings in 2023.
Good data, you guys. If it's coming too quick, go back and re-listen. Yeah, Neal is a data machine, and I can just hear it just comes off just like that. So let's talk a little bit about interest rates. Where do you think we're going from here if you had to put kind of a 12-month, 24-month projection out to our listeners?
So I think the Fed has been right all along in the last 18 months. So firstly, the Fed was wrong before. They thought that inflation was just, temporary. Obviously, they completely had to eat humble pie. But once they started raising rates, their projections have turned out to be right. Wall Street has turned out to be wrong. Wall Street thought we would be done by now. Rates would be going down by now. If you look at Wall Street's projections from the last 12 months, the Fed's projections that they had, they call it the dot plot, and they publish it after every meeting. They've been spot on. And so if I follow their dot plot, we're going to see small decline. And the Fed is the most conservative, by the way. The market still does not believe that the dot plot is right. The market thinks rates are going to come down faster. There's a projection that's readily available on the web of all of the different smart people in Wall Street. They put together their projections into this one place, and everyone looks at that. That shows significant declines in interest rates in the second half of 2024. The dot plot shows small declines in interest rates in the second half of 2024, followed by significant declines early in 2025. So I'll just say this: if the Fed is right, we will have significant declines by the first half of 2025. If the market's right, we'll have significant declines as early as the end of next year.
Wow. Well, that should give a lot of relief to a lot of owners. Maybe if you've got a bridge loan and you just extended your rate cap, right? and you've got a great fundamentally growing deal as far as income and your NOI is moving up, you may have a chance come 2025 to exit and hopefully break even. Maybe you make some money if it pulls back enough and prices kind of start to come back. Once you see prices start to come, or let's just call it interest rates coming back down, Neal, what sort of timeline do you project where you're going to start to see values coming back up in the multifamily space?
I have great historical data to share here. If you think about when did the Fed really start raising rates? Well, their first raise was like March 2022. And you notice, what did I say about 5 minutes ago on this podcast? I said, what was the peak of multifamily? It was March 2022. When did the Fed start raising rates? March 2022. So cap rates were the lowest in the United States, right? Which means the highest price in the same exact month that the Fed started. And since then, now that the Fed's raised from 0 all the way to 5.5, so right now we're at 5.5 for the Fed funds rate. That's not the mortgage rate, but that's the rate that influences the mortgage rate, right? And mortgage rates tend to be a little bit higher than that rate. So that rate's gone from 0 to 5.5 in a fairly smooth fashion, aggressive, now slowing down over since that March timeframe last year to now, let's call it 18 months. And in that 18 months, equally smoothly, we have seen cap rates go up, which means prices have come down by between 100 and 150 basis points in every metro in the United States. So some metros, they've gone up by 100 basis points. Others have gone up as much as 150 basis points. Phoenix being a perfect example of a super hot, ultra hot boom market that's seen 150 basis point jump because it was starting at a very low base. So it had longer to go. And then you've seen Midwest markets that might not even hit 100, maybe they're at 95 basis points. So that's where the ecosystem is. A smooth increase in cap rates has occurred with a smooth increase in interest rates. There is no data that I can find going all the way back to World War II, and I'm obsessive about data. I live in graphs, I live in charts, that suggests that if rates come down maybe 200 basis points over the next 2 to 2.5 years, that we wouldn't retrace half of that drop increase in cap rates. So let's just say this again. Cap rates have caused multifamily prices to go down by 25 to 30%. I think the bottom is going to be 30%. We are not going to go back to that peak for a long time. I think the next time we hit the same dollar numbers that we saw in March last year is going to be in 2028, 5 or 6 years from now. But what will happen is that as rates slowly go back down, we will retrace halfway. 30% discount being that bottom for multifamily, we're going to go up 15. So that 15% difference, we're going to recapture over the next 2 years. Now, going from 15 all the way back up to the 2022 prices, maybe even 2028 might be a little bit early. It's going to take a long time to get back to those numbers. So the people don't hold on to your property. If you bought it 2022 and you're bleeding money, you might as well just sell it, because you'll be waiting for a very, very long time, at least 6 years, 7 years for that to happen. But for the rest of us, we have this 15% change to capture. And that is incredible. And investors don't realize, because 15% seems small, right? But you're only 40% of a property's purchase price comes from investors, right? So if you can get out of that 40%, if you can get a 15% catch up, just because of cap rates, not even because of your rehab plan, that makes it so much easier to almost double investor money in 6 years. Notice that I no longer say 5 years. That's because of what happened now. Our timeline in multifamily has gotten longer. So whatever we used to say in 5 years, let's say we said we will get you a 1.8 equity multiple in 5 years. Well, that number now has to say 6 years, because more people are doing fixed loans, right? And more people have to do fixed loans based on what happened. So that has become 6. But it's much easier to hit that number, much more predictable when you've got cap rates in your favor. And I'm telling people today, statistically speaking, it's almost impossible that cap rates will not be in your favor if you are holding an asset for the next 4 to 5 years. They will be in your favor. Hopefully you're buying now. If you're buying in 2020, so obviously you've seen values decline and they'll come back over time. Hopefully you can hold on. But if you're purchasing an asset today, you're only getting a tailwind with no headwinds.
Let me just reiterate what you just said, Neal, just so the listeners heard that. You're saying it's almost impossible, if you're buying today, that cap rates are not going to be in your favor if you're buying now.
almost impossible, statistically speaking, unless something truly, truly bizarre happens in the world. So I'll say, like, if the United States fights a long-term 24-month war with China, well, that could be a different case, right? So, and by the way, that's a very, very good case for us, because anytime there are wars, it creates outrageous inflation later. And obviously, real estate is a massive beneficiary of inflation. But in the short run, you would see lots of problems. In the long run, you would see lots of benefit. So wars are not bad. In fact, wars are really, really good for real estate assets because of, necessary inflation. You have to run much larger deficits. You have to bring interest rates down. You have to do all kinds of things during wars. Bottom line is, other than that weird kind of, issue, statistically, it's almost impossible not to get a tailwind from cap rate compression here at the end of 2023 if you're buying an asset now. Now, people might say, do you know when? And my answer is no. I can predict trends, but I cannot predict their timing. I've tried to do that before, and I have been wrong with the timing. So I'll simply say, hold it for the next 3 years until the end of 2026. You're going to get a tailwind.
So, pricing we're seeing has dropped 20 to 30% on deals already. The deals we're looking at from where they were at the peak, late 21, early 2022. You just said right there, I can't predict the bottom, right? You're saying, who knows, we may continue to go down a little bit more, but we're already seeing it very low. And if you hold on for a 3-year period, until 2026, you're going to see cap rates help you. Do you see inventory ramping up over these next 2 years with distressed assets, or what do you think it looks like? And let's just talk about maybe Dallas, Fort Worth, since a lot of folks are investing in DFW, and it's a market that's very familiar.
DFW actually is a perfect example for what I'm about to say. So inventory should be peaking in Q3 of next year. So a year's 4 quarters. 2024 is the distress year for multifamily, and then distress ebbs in going into 2025. So here's first, I'll define the distress time frame, and then I'll define the inventory. Okay, so Q4 here, there's not a lot of inventory because we're still not at the point where all the cash calls have ended. We're still not at the point where deals are still being made with banks. The can's still being kicked down the road a little bit, and you can do that early in this process, early in the distress process, and we're still doing it. So we don't have a lot of inventory, though I've seen a lot of really good inventory come to market in October 2023 and at impressive cap rates. I just bid on a property. It did have 24 offers, but they were all clustered together, and the offers were right around 5.7 cap, right around 5.7 cap, right? This property would have received 34, 35 offers in March 2022 at around 4.2 cap or 4.3 cap. So you see that huge reduction, 27, 28% reduction from that 4.2 to 5.7 cap difference, right? So we're not seeing a lot of inventory. Distress starts in Q1 next year. So Q1, Q2, Q3, and Q4 are distress, and then Q1 of 2025. So I am predicting a 5 quarters of distress. I don't know when it peaks, and I'm going to guess that it peaks around July next year, July and August. It doesn't mean that after August there isn't distress. It's there, but distress builds up and then distress starts to release, right? So there's an up and then there's a down. From here until July, I cannot see any way that distress doesn't just keep going up. And then it starts to level off and then go down. And what makes it go down, right? That's really the key question. What makes it go down? And obviously, if distress peaks in July, I'm also saying, Dan, that inventory peaks in July, right? Because distress and inventory, they're tied together, right? So what makes it peak? Why would it peak in July next year when rates haven't dropped? And I'll tell you, there are 2 critical elements that make it peak, even though rates haven't dropped by July. And we can talk about that.
Yeah, let's hear what makes it peak July.
So there's things that are leading indicators and things that are trailing indicators, right? We know this, right? Certain things you lead, certain things trail. Cap rates are a trailing indicator. They take a long time to adjust. So it's taken 18 months for cap rates to go from 4.2 to 5.5 or 5.7, right? They're a trailing indicator. But when people start looking at properties and they start getting bullish, they look at leading indicators, not trailing indicators. The number one leading indicator that helps the multifamily industry is rate caps, not cap rates. Cap rates are the trailing indicator. Rate caps are a leading indicator. Now, most people that are in the multifamily industry, are not as math inclined as me. And so there's a belief that rate caps are high because interest rates are high. My analysis indicates that this is 100% bullshit. Okay. Rate caps have nothing to do with interest rates. Nothing at all. You can have ridiculously low rate caps, ridiculously cheap rate caps if interest rates are at 20%, right? Rate caps are priced based simply on the direction of interest rates, right? Rates are going up, rate caps are expensive. Rates are going down, all of a sudden rate caps are cheap. Why? Because they're a hedge. And whoever is selling that hedge bases everything based on our rates going down or our rates going up. Does that make sense? So the fact that rates are very high has nothing to do with the price of rate caps. So let's say in the February meeting, the Fed makes a very clear statement that they haven't made yet. So they have a November meeting coming up, then they have a December meeting. I think they're gonna stay at this point because of what is happening abroad with the treasuries. If you don't understand that, the treasury and repo market is in extreme distress. I won't say more than this because this is macroeconomics, but to say China is dumping treasuries and that is causing chaos in the world markets. None of this is public news because most people don't even understand treasury markets. They understand the stock market, which usually doesn't react to these sorts of things. So as a result, I think the Fed will just stay in November, stay in December. And then in February, I think the Fed actually says out of their mouth, we're done, right? We're done. We're not going to raise anymore, right? At that point, you have only two choices, plateau or down. And you don't know how long the plateau will last, right? Somewhere around June or July, we should finally see the Fed say, okay, I think we'll cut once, quarter point. I think the economy is in a recession. We're going to cut once. When they cut the first time, now the direction of rates is down, right? No matter how long it takes for them to get low, the direction is down. Guess what happens to rate cap prices? They plunge. They don't go down, right? Even though the Fed's only cut rates by one piddly little quarter point, the direction has changed. The moment the direction changed, rate caps don't go down by 5 or 10%. Rate caps become cheap. And we've been used to low rate caps for God knows how long, 10 years, right? We've been used to piddly, ridiculously cheap rate caps. Bottom line is, you start to see some of those prices, not immediately those prices, but you start to see those prices because now rates are going down. And that helps reduce the distress. Not every property is going to benefit, but some properties, the bank's just going to come in and say, fine, you're having trouble selling, you're going to lose money. Why don't you just go gather enough money to buy another one of these cheap rate caps? And we'll just let you kick the can down the road. Now, banks are not doing it they're going to make it seem like they're doing it for you, Dan. They're not. They're doing it for them because that is the peak of distress. They're getting properties back every week. And they don't want more people handing in the keys because the banks are the world's worst people to manage properties. They are amazing at running them into the ground and they do it with complete consistency, right? They're awful. So the bank, when it gets to peak, banks are going to say, hey, cheap rate caps, why don't you buy some? And they're going to kick the can down the road. And that's what allows that distress to ebb a little bit. It's still there, but it ebbs. The other part of it is bridge loans. Most people, once again, think that bridge loans are tied to interest rates. They're tied to the direction of interest rates. Today, bridge loans are there. Anyone can get a bridge loan, but the math doesn't make sense. We're all math driven. We look at underwriting, we look at bridge loans and we go, nah, this doesn't make sense. But the moment rate caps become cheap and bridge loans come down a little because direction has changed, the combination of bridge loans and cheap rate caps mean that bridge is now a factor, not in every property, but in enough properties for the distress to ebb a little bit. Therefore, beyond July, you start to see the distress slowly start to ebb away. And that is the point where the institutionals come in. We've been saying for 2 years, Dan, there's more dry powder for multifamily than in history. That's true. What we really should be saying, institutional capital is so smart and so math-driven that they will sit on those sidelines for another 3 or 4 or 5 years until they are convinced that it's the right time to enter. It's the syndicators that have basically been buying assets. The institutional capital has been sitting on the sideline. I believe that the moment the direction of rates changes, that is what gives institutionals a signal to start piling into the market, and that also ebbs the distress a little bit. Now you've got three things: rate caps, bridge loan availability, and institutional entry, all leading to slow ebbing. And that's why by the first or second quarter of 2025, the distress starts to end in the marketplace.
Wow. I love the data. I love it. And all of what Neal's talking about, I can say firsthand is 100% accurate when it comes to rate caps. Say what a rate cap's going to cost. We've got a deal. We're looking at buying a rate cap. Here's a question I have for you. If you're an owner, do you buy a 6-month rate cap in hopes that you could buy another 6 months later because you might see a massive decrease in cost to these caps, or would you buy a full year and risk more money?
So today, what I would say is, because I have investors, I'm going to buy a 1-year rate cap because there's this perception that I'm taking too much risk with their money. If I'm buying a building with my own money, no investors, I buy a 6-month rate cap. There is absolutely no logical premise for buying a long-term rate cap. The other problem is with a 6-month rate cap, sometimes you can't get loans. The banks are too concerned. So a 1-year rate cap may be the one that makes the most sense. There are certain lenders that are forcing you to buy 2-year rate caps because they're afraid that this may even go higher. So, the 1-year rate cap is almost inevitable at this point in time, and you may get forced into buying a 2-year rate cap, which would be a tragedy. But keep in mind that if rates do go down, then that rate cap can be sold. It has value.
Okay. What other data do you think would be prevalent for us to discuss as you're looking to move into 2024 here and 2025 as an investor? What are you looking for? Is either in buying a property, or B, as investing with a general partnership group?
Supply matters a lot. Early in the cycle, you want to go to where the boom towns are because you're seeing rapid compression in cap rates, you're seeing rapid growth, you're seeing people flooding into those markets, rent growth is very high. Towards the end of a cycle, you want to go to where the supply is the lowest. So today, you would be surprised to learn that the Midwest leads the United States in rent growth. Every Midwest market, even the markets that are not growing, right? So you see Cincinnati and you see Pittsburgh, and you see markets like that you typically don't think of as rent growth leaders or anything leaders, but they're leading the country in rent growth. Why is that happening? Because in a market of millions of people like Pittsburgh, total incoming construction might be only 4 or 5,000 units. Whereas in a market of 2 million people, Austin has 48,000 new units coming in. And in an environment where rent growth for the last 12 months has been zero, having massive incoming supply and then having concessions of 2 months of rents free drives down rents for everyone. So today, actually, it makes sense looking forward to look at some of the cheaper markets like Midwest, because you'll get positive rent growth there. And so I'm looking at supply. There's lots and lots of free data on which markets in the United States have the highest supply. Look at Yardi Matrix webinars, look at RealPage, look at CoStar. Everyone's sharing that data of which markets are the most supply constrained. Now, some of them happen to be the best markets in America to invest in, but why invest in them now? Wait for the next 18 months. The supply, this huge tsunami of supply will over time ebb. Wait until then.
But when you're saying too, supply, are you comparing A class across the country? Are you talking B and C class? Because what we found in our portfolio, and we're looking at some deals, is some of our B and C class deals have incredible pent up demand. And then our A class deal in a different part, is obviously a total different ball game. So when you talk about supply, what would you say in regards to B and C class property over the next 12 to 24 months?
Honest answer is this, okay? There's the total amount of apartment supply in a market is tied to household demand. So, and that household demand gets split up between A and B and C. So it is not appropriate to say, because all of the incoming supply is A and because I'm buying C's, I won't be affected. Okay, that is a common statement. It is wrong. Here's the right statement. I'm going to be very precise. If there's a large amount of incoming supply of A's today, A rental growth is going to be negative for a while. If there's a large, Austin's a perfect example, the rent growth is going to be very negative, maybe even 5, 6, 7% negative in A growth. B rental growth might be slightly negative, right? And B occupancy might be slightly affected. A occupancy is going to be severely affected. B occupancy is going to be affected a little bit, and it might be negative rental growth. C occupancy may not be overall affected, maybe a slight downward effect. And C's rent growth is going to be curbed. It might be positive, and ordinarily would have been 3 or 3.5%. Well, now it might be 1%. where B is -1 and A is -5. So there is an impact that's downstream. Also, the impact takes time. If the supply hits this month, right, the impact on B's will be 6 months from now, and the impact on C's will be 12 months. So the impact first is delayed as you go down B and C, and then the impact is reduced as you go down B and C, with C seeing the lowest impact 12 months down the line, with B seeing some impact 6 months down the line, with A seeing immediate impact. Because in the end, there's more units in that market and they have to get adjusted. So everyone suffers a little bit.
Got it. So there you go, you guys. Understand the location and asset class you're buying and what's coming with supply and demand. Try to get a real clear projection of what your occupancy is going to be looking like in your submarket, and get clear with general partner. Make sure they know that submarket and have a good understanding of these next 12 to 18 months, 24 months with what's coming online. Continuing on here, just moving a little bit towards your technology side. Are there any real estate technological innovations you're keeping a close eye on right now that we should share with our listeners?
For the moment, obviously, everyone's trying to figure out how to use AI for things like property management, for things like engaging tenants. That's fantastic, and there's tools already being built, very impressive tools that we're going to see, and we're going to start seeing a lot of artificial intelligence engagement on the tenant side. I'm seeing interesting tools that are using AI on the predicting where rent growth, scenario would be, but I don't find them to be mature yet, Dan. These are all very good efforts. I think that some of these companies are going to become billion-dollar companies, and CoStar will buy them because, that's what all CoStar seems to do. They seem to spend 80% of their time buying competitors and then jacking up their prices 10x. So somebody will, there will be a company that eventually CoStar will buy, but I don't have a winner here to name. I think a lot of people are doing very clever things to try and predict future rent growth and future cap rates using artificial intelligence, but I think these are efforts that are not quite mature yet. And then there's technology like 3D printing that is going to completely and ridiculously change real estate, but it's 10 years out. Even the people that are building those homes in Austin are saying, look, I mean, if we didn't have ridiculous amounts of grants and we didn't have ridiculous amounts of venture capital money, there's no way we could have built even one of these homes, let alone 100. So I think we're at the point where we are a little bit insulated from technology for the next 3 or 4 years. But beyond that, I think that there's very large amounts of real estate disruption coming.
Interesting. With the 3D printing still 10 years out, quick high level, how will it affect it? What will they do? What's going to happen?
In 10 years, a 3D printed single family home, it will be 20 to 30% cheaper than it is today. And that will disrupt the apartment market simply because a significant portion of the people that are living in apartments today will be able to afford single family homes. Disruption is inevitable, but it takes a long time for there to be cheap, fast 3D printers that build homes for 20% off.
So are you implying, this might be a really dumb question to be asking, but are you implying that the 3D printers will build places for people to live?
Google Icon, I don't know if it's ICON or IKON. Currently, Icon is building 100 3D printed homes in Austin. These are homes, and they are wonderful, wonderful. It's ICON. So Icon Build, ICONbuild.com, and you can go to their website, or you can go to YouTube and watch how they're building these homes. You'll see the homes being printed. You'll see the printers moving, and they look very nice. By the way, I find them to be very good looking. I think most people would find them to be good looking. So Icon is one of the companies that is building 3D printers. Their 3D printers, I think, are about 30 feet wide, 60 feet long. They come on a flatbed truck. They install them on a site, and it prints a home, and then you lift it off, and then you move on to the next pad.
Wow. So you're saying within 3 years, there could be some disruption in the multifamily space from 3D printers?
No, within 3 years, we are going to see significant disruption in the real estate industry. The disruption that comes from 3D printers is still about 10 years away because of volume. Remember, today, the price of both the Tesla Y and the Tesla 3 are the lowest in history. Even adjusting for inflation, it's the lowest in history, right? Sorry, even without adjusting for inflation, it's the lowest in history. Why? Because we started building the 3 in 2017 and the Y in 2018. Just to get to that scale, right? With all the gigafactories and the Giga Berlin, the Giga Shanghai, it still took them 6 years to get to the point where they can start cutting prices and still make money. With 3D printers, it'll take longer because there's no iconic company like Tesla in the 3D printing realm. So I think it takes them 10 years, but in 10 years, they completely change the face of how we do real estate in the United States.
Unbelievable. Well, it's exciting stuff. Any other advice for aspiring real estate investors out there, Neal, before we wrap this up that you think would be good to share? And then I want to also ask you about your Magic of Multifamily Bootcamp and what it is, and tell us a little bit about that.
First piece of advice, change your mindset. You've been hammered by what happened in the last 18 months. Let it go. Let it go. There's nothing you can do about it. Every area has cycles. You've been told that there were cycles. You refuse to believe that there were cycles. Now you've got proof there were cycles. We're in the down cycle now. Let it go because your opportunity is maximum today. Now, your investors don't believe that. Spend 50% of your time convincing your investors that the opportunity is there, that they're going to miss out. Create FOMO. It's real. The opportunity is real. Create FOMO. I'm spending 50% of my time doing what is known as distress watch. I am taking every opportunity I can in every different form, 9 different ways to get in front of my investors and tell them there's distress coming. You need to have dry powder. We are going to buy a bunch of properties and we're going to do really well on them. You need to say that. So one of the things that I'm doing is this is not something that I can do on my own because I'm influencing 1,000 active investors. Well, the real estate industry has several 100,000 active investors that invest in syndications. So what I've decided to do is I created an extraordinarily beautiful presentation about how investor mindset completely destroys profits. It's their mindset. They make the exact wrong decisions at the exact wrong time. And I'm giving the PowerPoint presentation away to anyone that is raising equity. It's completely free. Anyone can receive it from me. There is no quid pro quo. You don't have to do anything for me. You do not have to ever talk to me again. And yes, it's PowerPoint, not PDF. You can obviously delete my information and feel free to do that. You do not have to tell people you got this presentation from Neal Bawa. Why am I doing this? For selfish reasons. If 100,000 of us were telling this story to investors, basically the mindset would turn around and all of us would receive a lot more money. So it's an extraordinarily beautiful presentation. It comes with speaker notes. So every single word that you're going to say is in there. And it's available. Anyone can email me at Neal, Neal, at grocapitus.com. Maybe you can put that in the show notes. So Neal at grocapitus, grocapitus.com. It is a 300 megabyte file because it's very beautiful. It has animations and videos, but it's yours. Use it as often as you can. And if you want, you can also ask me for email templates. I have 3 or 4 email templates of the emails that I sent to investors for this presentation. It's completely free for you. It's my gift to you. Most importantly, it helps me because I think we have to very quickly turn investor sentiment around because Dan and me and everyone else, we need to buy a few thousand buildings.
That's it. I could not agree more. There was a time to put capital into multifamily. These next 12, 24 months is going to be the window that we've been waiting for a dang long time. So thanks again, Neal, for coming on the show. And thank you, everyone, for tuning into this episode. We couldn't do this without you guys. So please do remember to leave us a rating and review. And remember to tune in again next Tuesday for another episode of the Keeping It Real Estate Show. Neal, thank you again for coming on.
Thanks.